Welcome to the monthly Truck Stop webinar. I'm Keith Klingenberg from TrueNorth Companies and also a member of the advisory board of the Motor Carrier Insurance Education Foundation. Truck stops are presented the second Thursday of each month at 2 o'clock Eastern Standard Time. These webinars are presented as industry updates for informational purposes only and do not qualify for state CE credits. If you are seeking CE credits, email trs@ibci.net and we'll send you information on those opportunities. If you have any questions, type them in the chat window. They will be answered as time allows, or we'll respond after the webinar via email. If you experience audio problems, please send us a note in the chat window or call 800-741-4084. We'll attempt to correct the problem as soon as possible. Today, I have a really unique opportunity to introduce a person who I met over 20 years ago. 20 years ago, he was a young punk underwriter, and I had just founded the TLC group and was responsible for protecting the assets of 23 warehouses and several hundred tractor-trailer units. TLC was a full logistics service offering, and I found that no matter which agent I worked with, it always made more sense to go around them to the underwriter, who proved to be the smartest person who I've come across in this industry. And that happens to be my now partner, Dan Cook. It's a privilege to introduce him.
Thanks, Keith. I appreciate that, and I hope not to disappoint the audience today with some perspective and background on the warehousing industry and the roles and responsibilities with the party. Keith and I and Tommy have a few goals for today, and Tommy cautioned me that we do have a mixed audience. I understand that we have representatives from the warehousing industry, the trucking industry, the insurance community all called in today. And so we'll do our best to talk from each of those perspectives. Our goals include, really creating some basic understanding about the parties involved in a warehousing transaction and the responsibilities that each bring to that transaction. The limitations on liability that are placed upon a warehouseman and where those responsibilities and liabilities come from. One of the areas that derive a great deal of the responsibility for the warehouseman is the Uniform Commercial Code. And we'll talk about the role the UCC plays in both imposing and limiting liability on the warehouseman. We'll talk specifically about the non-negotiable warehouse receipt and standard warehousing agreements, the provisions of that document, and how they impact not only responsibility, but then the insurance that follows. We'll drill in at the end into some specific insurance implications. We'll identify some gaps in understanding between the parties as well as understanding of the insurance coverage. We'll talk about the interrelationship of specific insurance policies such as personal property, stock, motor truck cargo, and warehouse legal liability. And then to kind of package up that whole insurance discussion, we'll talk about a claim and some thoughts about how different policies might respond and the role of subrogation in the process. So it's good to first start talking about just warehousing in general and the parties to the warehouse agreement. Typically, a warehousing agreement has two parties. But we all know there's not only two parties that are thrust into many of the disputes that play a role in that relationship. So I've added the motor carrier or the transporter of the goods that are moving for storage. So the first party is the bailor or the depositor. This is the individual that owns the goods and is placing those goods in temporary storage with the warehouse. The motor carrier is responsible for moving the goods, often from the owner's own warehousing or manufacturing or whatever location, to the warehouse and then the bailee being the warehouseman that receives the goods and offers a certain degree of care for those goods while in their care, custody, and control. Let's talk about the bailee first. The warehouse has certain standards of care that are imposed upon them. And the first one really has its origin in common law. If you look up in Black's Law Dictionary, Sir William Blackstone wrote that a consignee should use a reasonable and prudent degree of care, one much like they would use in caring for goods they own themselves, caring for goods of others. And from that original writing came what we term to be the reasonable and prudent person's doctrine. That doctrine forms the basis of responsibility in the warehousing industry today. Some of the characteristics of bailment, which are essential to this understanding, include that transfer possession does occur, but transfer to title does not. Ownership of the goods remains with the bailee, the bailor, not the bailee. It's simply possession of the goods that moves to the warehouse. Possession, therefore, is deemed to be temporary. It's not intended to be permanent. In most instances, it's not intended to be long-term. And possession is always intended to revert back to the owner, back to the bailor at the end of the warehousing period. There's really only one time that we commonly discuss change of ownership, and that is when the warehouseman is forced to place a lien upon the property, and in order to protect their lien rights, usually for failure to pay for storage, the warehouseman must pursue title to the goods in order to sell them to recuperate their loss. But as a general rule, the warehouseman simply possesses and the owner continues to own. The bailee, therefore, the warehouseman, has care, custody, and control of the goods while the bailor retains title. So oftentimes, the warehouseman or people generally think that should something happen to the goods, the warehouseman's general liability policy might respond for their negligence in care of the goods. But virtually all, in fact, I probably can say all, commercial general liability policies have a care, custody, and control exclusion that prevents coverage from arising in their general liability policy. Hence the need for alternative coverage and things such as the warehouse legal liability policy. So some basic understanding around the warehouse industry and some basic understanding about how each other relate is important. First of all, I think it's a fair statement to say that responsibility for damage to goods and the insurance coverage that's provided are often misunderstood. And that's a universal misunderstanding amongst the bailee, the motor carrier, and the warehousemen themselves. And oftentimes, it's a misunderstanding amongst the broker community that's placing the coverage because each of the parties lacks all of the necessary information. Each of the parties often brings their own insurance to the transaction, thinking about their interests, and not always having all of the information as it pertains to how a loss might occur. So the bailee, the first thing to know is that the bailee-bailor relationship does not transfer all risk of loss. It's important to know that the UCC, or Uniform Commercial Code, identifies the duty of care that's imposed upon the warehouseman, and it limits the level of responsibility that they have for the care of the goods. And therefore, it limits, if you think about it one step further, the insurance that's necessary to be brought to the relationship by the warehouse. The warehouse agreement can increase the duty of care beyond that which is specified by the UCC, but it cannot reduce the duty of care. So let's think about that for a moment. UCC has established a floor, a standard of care that warehouses must engage in. But if I'm a shipper, do I want that standard of care? Or might I, particularly if I'm a large shipper and have the means from which to negotiate a broader degree of care, an additional degree of care upon the warehousemen if they're going to gain my business for storage? This poses a challenge for the insurance industry because there is a separation between risk that's assumed by contract and insurance that is granted by coverage. So it is quite possible that in a warehouse agreement that does not limit care to what's provided by the UCC, you could simply be assuming risk you do not have insurance coverage for. Several types of insurance, therefore, come into play to properly and adequately insure the goods that are being stored in any warehouse environment. And we'll talk about those types of insurance in greater detail in a bit. Let's first talk about the Uniform Commercial Code, specifically Section 7-204 and Item 1. And this speaks to the limitations of responsibility that the warehouseman has. So Section 1 says a warehouseman is liable for damages for loss of or injury to goods caused by its failure to exercise such care in regard to them as a reasonably careful man would exercise under like circumstances. There's our reasonable, prudent person standard. But unless otherwise agreed, he being the warehouseman, is not liable for damages which could not have been avoided by the exercise of such care. So as long as they exercise reasonable care, other damages that occur will not be the warehouseman's responsibility. Item 2, damages may be limited by a term in the warehouse receipt or storage agreement limiting the amount of liability in case of loss or damage, setting forth a specific, pre-agreed to, if you will, liability per article or item, the value per unit of weight, beyond which the warehouseman shall not be liable, provided da-da-da-da-da-da-da. It's a large section that basically says the parties can agree in advance to a loss, the value of the goods, to some limit. And it lays out a very clear path to establish that limit. Section 7-204-2 provides further clarity. The first item is that the limit of damages must be by a specific liability per article or item and value per unit of weight. So it imposes a requirement on the warehouseman to be afforded the protections of the UCC that they do this. So when you look at your non-negotiable warehouse receipt that we'll talk about in a minute, there's an opportunity for the warehouseman to state the limit. An example of that limit might be $50 per barrel, $1 per pound, some fixed amount per unit of measurement as required by the UCC. This is pretty common when you're storing high-valued goods. I know at TLC, we've worked with a lot of pharmaceutical companies, and some of those shipments were incredibly valuable. This afforded his business the opportunity to limit their exposure to risk, to know their exposure to risk, and to appropriately insure for their exposure to risk. It would be much harder to ascertain without such a limit. Another basis commonly used for the limitation of damages is by a multiple of the base storage rate. Most courts have accepted this as consistent with UCC provisions. However, not all. Kansas recently did not allow this basis, and that exposed the warehouseman to a much higher responsibility for damages. So I generally recommend, and I think other industry professionals advise, where possible, use a specific liability per article or item as opposed to using a multiple of the base storage rate. If multiple base storage rate seems to work better for your business, it's certainly advised that you seek counsel from an attorney within your jurisdiction that specializes in this area. Now I want to talk a little bit specifically about really the industry standard, if you will, non-negotiable warehouse receipts. I'm well aware that you know, some large warehousers or some large shippers use different customized documents. But really, since 1968, when the American Warehouse Association published their non-negotiable warehouse receipts, this has been the industry standard for how warehouse transactions are placed. So IWLA is broadly used today, and one of the terms, the very first term within the non-negotiable warehouse receipts states, warehouse claim to lien for all lawful charges for storage and preservation of the goods. Also for all lawful claims for money, advance, interest, insurance, transportation, labor, weighing, coopering, and other charges and expenses in relationship to such goods, for the balance on any account that may be due. So that's a pretty broad statement. That lien, we often think of a lien in relationship to the storage fees. But for long protracted disputes where the warehouse continues to store the goods, it's not unusual for the ancillary costs to approach the cost of actual storage. The second thing that's stated directly on the face of the receipt is that the property covered by this receipt has not been insured by this company, meaning by the warehouse, for the benefit of the depositor, meaning the bailee, against fire or any other casualty. So what are some of the casualties you can think of recently that have caused damage to goods in public warehouses? You know, I'm talking to you from northern Michigan, and I can tell you in the Great White North this year, we saw a lot of snow. And I think across the north in this country, we saw an abnormally large number of collapses of warehouses based on excess weight, snow, and ice buildup. Is that another casualty of loss that the warehouse might not be responsible for? Is it a casualty of loss that's encompassed in the statement that they're not buying insurance for that? I think it certainly is. If you watch the news today, you'll see wildfires in Southern California. All too often, we see tragic tornadoes occurring in the Midwest and Plain states. So the warehouseman is telling you right up front when you place their goods, we don't buy insurance for that. UCC will speak to it, and the standard agreement will speak to it further, and I'll talk to you about that as we get into this conversation. Next, it says, this is to certify we have received the goods listed hereon in a parent good order, except as noted hereon, where they will note any damage that's apparent. However, content, condition, and quality unknown. So I'm telling you right up front, I don't know what's in your container. I don't know the condition it's in, and I don't know what quality it is. Again, this will be important as we talk about limitations of liability and defense of claims from the warehouseman's perspective. And then Section 11C is on the back side of the non-negotiable warehouse receipt. This is the blank space for limitations on damages. This is where you can write in $1 a pound, $50 a barrel, or whatever amount is agreed to. So the standard warehouse agreement has a number of terms of significance. And while I haven't picked them all, I thought it would be useful discussions to talk about some of them just specifically in the context of assumption of liability, management of risk, and insurance. And it provides begins to provide some guidance that we'll speak to later as to how a claim might proceed should there be damages to a bailee's goods. So the first item, acceptance. There are 4 sub-paragraphs within acceptance. What I want to point to is that there are certain responsibilities of the bailee or shipper to do some things one, it gives the opportunity, it assigns the responsibility for the bailee or depositor to sign the warehouse agreement within 30 days of delivery of the goods. Should they fail to do so, the warehouse agreement then becomes effective, and the consignee has failed to take advantage of their opportunity to inspect and review the warehouse facility. So at that point, they are basically saying, yeah, we inspected it and we're satisfied with the quality and condition of the warehouse. The next section is shipments to and from the warehouse. This is an important section. It is the first time in the agreement where the warehouse is making it very clear that they have no intention of taking ownership of the goods, and that ownership of the goods remain with the bailee. And they hold the bailee responsible for not implying to anyone else that the warehouse ever owns the goods. In fact, they say that the bailee shall not identify the warehouse as the consignee, and if in violation, the depositor does, on the bill of lading, imply to the motor carrier that the warehouse is the consignee, the depositor must immediately notify the motor carrier in writing of the error. In the event that they fail to notify the motor carrier that the warehouse is not the consignee, the warehouse will no longer be responsible for any loss, consignment, or damage of any nature to or related to such goods. And the depositor, the owner of the goods, further agrees to indemnify and hold the warehouse harmless for all claims for transportation, storage, handling, and other charges related to such goods, including underage, fill-demerge, truck intermodal detention, and any other charges whatsoever. So it's very important that we maintain in this transaction ownership of the bailee, bailor, and not try to impugn ownership upon the warehouse. And really, from a practical matter for the insurance professionals on this call, we all know that that's critical to how the insurance policy is written for each party works. So the document speaks to that. The next item is tender of goods. I just simply read it to you. It says that all goods shall be delivered at the facility, the warehouse, properly marked and packaged for storage and handling. The depositor shall furnish at or on prior to such delivery a manifest showing markings, brands, and sizes to be tapped and accounted for separately, and the class of storage and other services provided. So again, it's another affirmative responsibility to the bailor to do certain things. The next item is transfer, termination, storage, and removal of goods. This is the largest single section of the agreement, and I would refer you to really item D. Item D gives the warehouse the right to sell the goods under certain circumstances to protect their lien. This is the area that allows the warehouse to capture costs, access storage costs, and provides a means by which they can liquidate the property. In Section E of the agreement, it also imposes liability upon the consignor for other damages such as removal that the warehouseman might incur. The next section we'll speak to is Section 6, and that is handling. Item E within this states that the warehouse shall not be liable for any demurrage or detention, any delays in unloading inbound cars, trailers, or containers, any delays in obtaining or loading cars, trailers, or containers for outbound shipments unless the warehouse has failed to exercise reasonable care. Keep rolling back to this reasonably prudent person standard. And so if there's traffic snarls, if there's rail issues, if there's boats that are held up on the water, small pirates become a problem, the warehouse isn't responsible for any of that and the consequential losses that the the owner suffers unless they were directly negligent in the act. The next item to speak to is delivery requirements. Delivery requirements state that when goods are ordered out a reasonable time, shall be given the warehouse to carry out instructions, and if it is unable because of acts of God, war, public enemy, seizures, strikes, lockouts, riots, civil commotions, or any reason beyond the warehouse control, or because of loss or damage to the goods for which the warehouse is not responsible, it's basically not the warehouse's problem. And I think people miss that a lot. I think that many shippers think that if the goods don't leave the warehouse when they're supposed to leave, it's the warehouse's fault. There's a very broad range of defenses available to the warehouse for those assertions. Skipping forward, I would refer you to bonded storage. And certain parts of the country, this is a much bigger issue. In the intermodal community, when I was in the Port of Hampton Roads, I dealt a lot with bonded storage facilities. And I think people don't realize, unless you're in Long Beach or Hampton Roads or Dallas, just how prevalent the U.S. Customs Service is and the role that they play in these warehouse facilities. And under the bonded warehouse section, it says where a warehouse receipt covers goods in U.S. Customs bonds, the warehouse shall have no liability for goods seized or removed by U.S. Customs. And that happens commonly. What happens even more commonly is a class of goods might be suspected as necessary for inspection. Might be something suspected to be NM that's inappropriate. And so an entire group, pallets, containers of coffee perhaps, could be held in a bonded customs section while DEA or customs inspects them. While your goods may not have any issue, they also aren't going anywhere. And the warehouse has no liability in that area. The next section, and the section that probably pertains to the insurance community the most, it really affects all of us greatly, is Section 11. Section 11 is a section on liability and limitation of damages. Item A states clearly, the warehouse shall not be liable for any loss or damage to goods tendered, stored, or handled, however caused, unless such loss or damage resulted from the failure by the warehouse to exercise such care in regard to them as a reasonably careful person would exercise under like circumstances. That's pretty darn close to what it says in the Uniform Commercial Code. So it establishes clearly that this is it has to be negligent, which is, I hope, driving home the point here that the warehouse legal liability policy is a negligence document, just as your commercial general liability policy is. If you flip over to item B within Section 11, it's a simple but powerful one-word, one-sentence form. It says, goods are not insured by warehouse against loss or damage, however caused. That means the warehouse doesn't buy property insurance on the stuff they store. They buy a liability policy to defend them for suits alleging their negligence. The next one is Section 13, liability for consequential damages. Warehouse shall not be liable for any loss of profit, or special, indirect, or consequential damages of any kind. This is huge, and this poses a particular challenge to the insurance community that we do a generally poor job of solving for. If I'm storing a partially finished product that needs to be in the production process on a certain date, and it doesn't get there, you may have a claim against me for some per pound amount or some per unit amount, but the real loss to the owner might be that their product is no longer needed by the manufacturer for the next phase of production. It might be that an expiration date is met. It might be that there's liquidated damages in the contract they have with the manufacturer and they're subject to fines and penalties. It's very clear in this agreement that the warehouseman is not responsible for any of those consequential losses. The next item is liability for misshipment. And there is some protection here for the warehouseman that I don't think most people think much about. It says maximum liability shall be for the lost or damaged goods as specified in Section 11 above. Section 11 above, for your reference, declares the per pound or per unit amount, so they're capping their liability only to that, should they misship the goods. And there would be no liability for damages due to the consignee's acceptance or use of the goods. So if they inadvertently ship the goods to the wrong manufacturing plant or warehouse, or the consignee takes it and they start to use it, at that point the warehouseman's off the hook once they've been accepted. The next item is mysterious disappearance. Warehouse shall be liable for loss of goods due to inventory shortage or unexplained or mysterious disappearance of goods, but only if the depositor establishes such loss occurred because of the warehouse's failure to exercise the care required under Section 11 above. So it creates a responsibility or burden, if you will, of the consignor to prove that the warehouse was negligent in the mysterious disappearance. And that's a tricky one. I see a fair number of claims settled in this area, where the defense put forth is that we're not responsible for mysterious disappearance. I don't see nearly as many claims paid in full in this area. The next item is another item that I just want to point out where the affirmative responsibility is on the owner of the goods, not the warehouseman, and that is accurate information. The depositor will provide a warehouse with information concerning the goods which is accurate, complete, and sufficient to allow the warehouse to comply with all laws and regulations concerning storage, handling, and transporting of the goods. The depositor is such a strong affirmative responsibility that it goes on to say the depositor will indemnify and hold warehouse harmless for all loss, cost, penalty, and expense, including reasonable attorney fees, which warehouse pays or incurs as a result of the depositor failing to fully discharge this obligation. So let's think back to something earlier that I said. We said that we said a few things. One of which is the warehouse states in their non-negotiable warehouse receipt that we don't know what's in the container. We also said earlier that the owner must tell the warehouse whatever is in the containers. And now we're saying you fail to provide that accurate information to the warehouse. If the warehouse suffers damage, you will indemnify Mr. Owner of the goods and hold harmless the warehouse for cost. What if there was a chemical inside a container that owner failed to disclose? There's a fire in the warehouse. And now we've got the pollutant drained into the public water supply and the neighbor's property, and we have a large remediation environmental impact expense. Well, the owner of the goods has agreed to indemnify and hold harmless the warehouse in the instance where they had not disclosed that that chemical was present. It could be an issue with explosions, it could be a hazmat related, it could be poisons. But the important point here is there are responsibilities on both sides, and when you sign the standard warehouse agreement as an owner of goods, you assume a bunch of them. Lastly, Section 19 of the agreement, and this is what establishes the lien rights for the warehouseman. And it says the warehouse shall have a general warehouse lien for all lawful charges, the storage, the preservation of the goods, also for all the lawful claims for money, advance, interest, insurance, transportation, labor, weighing, coopering, and other charges and expenses in relationship to such goods. get that. I have a lien against the value of your goods and all the expenses that I can think of that I incurred as a relationship to those specific goods that you failed to pay for the storage on. But further, it goes on to say, the warehouse further claims a general warehouse lien for all such charges, advances, and expenses with respects to any other goods stored by the depositor. So you've got multiple shipments of goods that have accumulated in this warehouse over time, and you haven't paid this one bill. Not only does the warehouse gain rights of lien to that particular code, they have a general lien against all of the goods you have in storage at their warehouse facility. And as we talked earlier, there are specific provisions with which they're allowed to take ownership and liquidate those assets. So all too often, what's kind of the moral of the story is, all too often we quickly sign or only partially complete a non-negotiable warehouse receipt. And there needs to be important consideration paid to what that document means. And I would encourage all motor carriers, warehousemen, and owners of goods to share those documents with their insurance brokers so they can properly protect the parties involved. So how do we go about insuring the personal property or the deposited goods? And I really want to break this into two sections. And if you can just get your mind wrapped around this, it'll make a lot more sense as to how claims occurred. The question is, do I have to sue somebody to get the policy to respond? Or do you have to sue somebody for their negligence? That's a liability policy. When you can file a claim in order to get a check to yourself, that's a first-party policy. There are two liability policies that are often involved in the movement and storage of goods. The first is the one that the trucking company purchases, one that many people on this phone are very familiar with. It's the motor truck cargo policy. What it covers is the loss of goods and merchandise of every kind, not otherwise excluded. So I'm talking in general terms here as I talk about coverage. I know each of you have different policies with specific endorsements and specific languages, but if you don't tinker with most cargo policies, they basically say we'll cover whatever it is you're hauling as long as we haven't excluded it. And then it'll say we will pay those sums you become legally, so it covers those goods. And then the question is, how do we trigger that coverage? And what the policy says is we will pay those sums you become legally obligated to pay as a transportation carrier under any bill of lading with some additional language for direct physical loss to property owned by others in your care, custody, and control while in the due course of transit by a covered loss. Now, due course of transit is a broadly defined term. It might include terminal locations and it might not. It might include some temporary storage and it might not. It might put a time frame around how long you can have it in a temporary environment. But generally, it says you have to be negligent as the transporter for the damage that occurred to those goods before we're going to pay a claim. So the shipper has to allege negligence and in some cases sue you and prove negligence before we pay for the loss. That feels and smells in practice a lot like a warehouse legal liability policy. The warehouse legal liability covers tangible property of others, basically the same stuff that we cover on a cargo policy, except it's the stuff which you have accepted as a warehouse operator or bailee. You've taken it into your care, custody, and control, generally from the motor carrier. And then how do you file a claim? The same way. We will pay sums you become legally obligated to pay as damages for direct physical loss caused by a covered cause of loss covered property while located at the premises described in the policy. So the motor truck cargo policy covers it while it's moving on the ground. The warehouse legal liability picks it up while it's in a storage premise, a premise that is described specifically on the warehouse legal liability policy. So now let's shift gears. In fact, let me back up for a second and try to wrap it up a different way. So the warehouse legal liability policy, the motor truck cargo policy, was purchased by who? Purchased by the person who has somebody else's stuff in their care, custody, and control. And it's purchased for whose benefit? For the people that own the stuff. If the insurance company cuts a check under a warehouse legal liability policy or under a motor truck cargo policy, they're going to cut it to the owner of the goods, not to the person that purchased the insurance. Now fast forward and think about your own homeowner's policy. Your homeowner's policy is a first-party property policy. Your contents, if you have a fire in your home, you purchase the policy and you purchased it for whose benefit? Wrong. When the insurance company cuts a check, they're going to cut the check to who? To you. So it's a very different relationship. You have to sue yourself to trigger coverage? Absolutely not. You have to do what? You have to prove that the damage that occurred to your property was caused by a covered cause of loss, something they agreed they would provide you protection against, and that will trigger coverage. So let's walk through some of the personal property coverages that can be used to protect these very same goods that are being stored in the warehouse facility. The first and most common is the business personal property policy. I'll use a manufacturer as an example. I manufacture meat, and so I've cut up all these steaks, and I insure them as part of my contents in my manufacturing facility or as part of my business personal property, along with the furniture, the machinery, and the equipment as part of my stock. They were insured as stock when they were a cow. They were insured as stock when they were a quarter. They're insured as stock when they're a steak. When they leave my dock, they become covered by a liability policy called a motor truck cargo policy. I, as the owner of that steak, can choose to continue to insure it as well. I could insure it on a shipper's interest or a contingent cargo basis myself. I could use a number of these different tools to keep coverage in what I hope is excess to the trucking company's coverage. When it gets to the warehouse, I get some protection, limited as we've learned by the UCC and by the non-negotiable warehouse receipt, against the negligence of the warehouseman in the care of my goods. But again, I could choose to continue to keep first-party coverage on it for things that, in the non-negotiable warehouse receipts, the warehouseman is not buying coverage for. So under a business personal property policy, I cover my furniture, my machinery equipment, my stock. And what triggers coverage, really, subject to all kinds of exclusions and limitations and different policy interpretations, is we will pay for direct physical loss to covered property at the premises, so it's location specific generally, caused by or resulting from any covered cause of loss, such as fire, theft, vandalism, could be flood, could be earthquake, could be changes in temperature and humidity. But we cover for those causes of loss that we agree to. Some warehouses, and in my opinion, take the misguided approach of buying personal property of others' coverage to try to address the risk of loss to goods in their care, custody, and control. So personal property of others covers the exact same stuff as the business personal property policy covers, except for its others furniture, machinery, and stock somebody has in their care, custody, and control, and it pays for the same basic causes of loss. We'll pay for direct physical damage to the stuff of others that you have in your care, custody, and control. So what's the downside to doing that? Why wouldn't a warehouse just buy personal property of others coverage on all the goods that they're storing? The answer is several. First of all, there's no defense. So now the claimant, the person that stored the goods there, only has to show that it was damaged by a covered cause of loss in order to trigger the claim, the payment by the insurance company. The warehouseman isn't in a position to argue that we weren't negligent, it wasn't our fault. So premiums for that coverage would be exorbitant because the claims would be substantial. The second is values that you would have to insure. Because we can limit the value of goods in storage as a warehouseman by the pound or by the gallon or by the barrel, we have to buy much less insurance coverage for a much lower limit on our warehouse legal liability policy than we would have to be if we were buying replacement cost coverage or market value coverage or selling price coverage under a personal property of others format in order to meet the co-insurance requirements. So the sheer cost of taking that approach is prohibitive. One of the ways that many distributors and manufacturers or people that store goods in common warehouses insure their stuff is under a stock floater. A stock floater covers merchandise held in storage or for sale, raw materials, and goods in process or finished. One of the advantages of using a stock floater is the multiple valuation provisions that are available. So the owner of the goods, while they might only be able to prove negligence with the warehouseman and insure their goods and cover from the warehouseman so much per pound, so much per barrel, they have the ability to insure the goods in excess of that. They have the ability to insure the goods for many more things that can happen to the goods while they're in that warehouse, and they can fill the gap between the responsible financial limit of the warehouseman and what they really need to be put back in the position they were prior to the loss. So using a stock floater, the owner of the goods might choose to insure them at their manufactured selling price. So that would insure not only the cost of the raw materials to make the good and the value add that occurs, such as labor input during the manufacturing process, but it also insures the profit that they were going to achieve through the sale of that good. They might insure it as stock in process. They only are insuring it at the accumulated value because they have not finished the manufacturing price and held the article for sale. If it's a stock that's traded on a public commodity market, such as a grain or cotton, oftentimes you choose to insure it based on its present commodity market value. In the cotton industry, that fluctuates greatly. Crude fluctuates. So it's sometimes a more viable way to do it. But remember again, the person purchasing this coverage is not the warehouseman. It's the person who's purchasing this coverage is purchasing it not for a third party's benefit, but they're purchasing it to protect their own interest. So if the insurance company cuts a check, they get the check. Lastly, we're going to talk about a stock throughput program. Stock throughput really was originally designed for companies that import or distribute or export merchandise. That type of policy provides cover for all movable goods, inventory, that are subject to the insured type of trade. It includes raw materials, semi-finished, finished goods, and the goods are really covered at all times during transit and while temporarily being stored. So stock throughput policy is really a marine policy that combines into a single insuring agreement, ocean cargo insurance, inland marine transit insurance, and also the stock floater or the property coverage over the goods. And you see that more and more common among large shippers and large industrial operations. I quite honestly think it has a number of inherent advantages and it reduces significantly the opportunity for a coverage gap. So it took me a minute to seem to be slow to change slides. There we go. Hold on, go back one here. Okay. So I just want to kind of wrap up. We've talked about limitations placed by UCC. We've talked about the non-negotiable warehouse receipt. I want to kind of talk about expectations of the parties and when insurance policies tend to fall short of expectations. First of all is when parties don't understand the limits of liability that the warehouseman has under the UCC Section 7. Second is when the storage agreement limits liability. Oftentimes, warehousemen will have other limitations within the storage agreement that help protect their interests. Various states, as we mentioned Kansas recently, interpret the statute differently, as do the courts, and so you might have jurisdictional issues come into play. Shipper negligence. One of the affirmative defenses that we discussed the warehouseman had was that it wasn't packaged properly. The damage occurred in the manufacturing facility. The temperature wasn't controlled properly on the way to the warehouse. So shipper negligence could leave an owner of goods disappointed. Shipper's failure to comply. This is why I took the time to talk about all the different affirmative responsibilities that are imposed upon the shipper under the non-negotiable warehouse receipt. And then lastly, and the biggie, is no negligence. If it's not the warehouse's fault, the warehouse legal liability policy isn't going to pay. And the same can be said true of the motor carrier's cargo policy. So let's kind of recap what are those common defenses that a warehouse might use that would result in an uninsured claim or dissatisfaction. Or it may be that there's just a lack of understanding among the parties, and therefore the owner of the goods failed to place coverage that was necessary because they just didn't know they needed to. So first of all is loss as a result of demurrage or detention, delays in loading and unloading, acts of God, sudden severe changes in weather patterns, strikes and lockouts, any cause other than the warehouseman's failure to act with reasonable and prudent care, causes beyond the warehouseman's control, that wildfire, severe, quick snow load that there was really no practical opportunity for the warehouseman to remove from the roof. A uncontrolled semi-truck that drives into the ammonia containment system and causes a change of temperature in the freezer. Things that the warehouseman could not control. Cost of cleanup, disposal, and site remediation when the warehouse isn't liable. And in some instances, if the warehouseman is not aware of all of the contaminants in the container, that the owner has agreed to indemnify and hold that warehouseman harmless. We talked about consequential, loss in market value, diminution in value. Often it relates to time because it's now been put where it's supposed to go at a later date. It isn't as valuable. And then we talked about unexplained disappearance. So as we think about damaged goods, and it's going to occur, goods will get damaged while in storage, we need to think about some claims considerations. And I always like to kind of lump things into buckets. I think about the first party claim. I think about where it's covered under my stocks, whether I own the goods and I've got property insurance that covers the goods while they're in that warehouse. So I'm not totally reliant upon the warehouse legal liability or the negligence of the warehouseman. In that instance, who would get paid? Well, I purchased property insurance on my goods. I paid the premium. I own the goods. If it's a covered cause of loss, my insurance company is going to cut a check to me as the owner of the goods. What's my burden of proof? Well, because it's first-party coverage, I don't have to prove anyone was negligent. All I have to show is that a covered cause of loss provided the damage to my goods. If the warehouse catches fire as the result of a wildfire, the warehouseman is not negligent, but I don't need to prove he's negligent. I just need to show there was a fire that damaged my goods. And then the valuation of goods. Under a property policy, we can choose all those different valuation methods: replacement cost, manufacturer selling price, commodity value. I can get full protection for my interest under a property policy, where I'm not as likely to get that under a negligence form. So now let's think about it from a negligence form or third-party claim perspective. The question is, who gets paid? Who gets paid is the plaintiff who can successfully prove two things: that the warehouseman was negligent and their damages. What's the burden of proof? Burden of proof is you have to prove that the warehouse didn't act in a reasonably prudent manner and that it wasn't an act of God or some other defense that the warehouseman has available to them. What's the value of the goods? Oftentimes the value of the goods is limited to 50 cents a pound, $50 a barrel, some predetermined set value, which quite honestly is often woefully low in relationship to what the owner of the goods needs. So how do I often recommend parties to this transaction to proceed? First and foremost is I recommend my clients that own goods to insure their goods properly. Insure the goods they store in their own facilities, but also in public warehouses. I then advise them to allow the determination of negligence, when possible, to occur between the insurance companies, not to get into a fight with the person that they're doing business with. When it's possible for shipper of goods, motor carrier, warehouseman to avoid direct litigation amongst each other, it's always favorable. And it provides the opportunity for an ongoing successful business relationship. So in the insurance industry, we use a tool called subrogation all the time. Subrogation is where the owner of the goods files the claim on a first-party basis with the insurance company that provides their coverage. The insurance company pays the claim. As long as it's covered cause of loss, they more quickly get the money to their insured, and then the insurance company that pays the claim looks around the room to see if someone else should have been held responsible. If they determine that the warehouseman, they determine that the trucking company, they determine that someone else is responsible, they sue that entity's insurance company. They subrogate back against the responsible party and look to get reimbursed the expense of the claim from the responsible party's insurance company. It's a fairly efficient means of letting the insurance company be insurance company as opposed to business partner versus business partner. A little bit of background on me. Tommy asked if I'd provide a little bit of a bio, and all I'd like to say is, TrueNorth and Keith and our group in particular are big supporters of the Motor Carrier Insurance Education Foundation, and my email address is there. And if anyone has any further questions or has a specific situation that they're wanting some advice on, drop me a note and I'll do my best to respond.
Thanks, Dan. You have proven why I always viewed you as the smartest, and just become smarter over the past 20 years. The next monthly truck stop webinar is scheduled for Thursday, July the 10th. It's the second Thursday of the month at 2 p.m. Eastern Standard Time. At that time, the subject will be Insuring in Canada, U.S. Insureds in Canada. These webinars are open to the Motor Carrier Insurance Education Foundation and Transportation Risk Specialist members only. If you know of someone who would be interested in membership, we've listed the contact information for you. On that note, thanks. See you next month.